It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token2049.
Welcome back to Real Vision Crypto. I'm Ash Bennington. Today, I'm joined once again by Sergey Nazarov, co-founder of Chainlink. Sergey, welcome back to the show.
Great to be here. Thank you once again for having me.
Always a pleasure to have you. Sergey, I know there's a lot of new ground to cover, but I want to do the 50,000 foot overview for people who may need a little bit of a refresher on what you guys are doing over at Chainlink. 50,000 foot Chainlink, what does it do? Why does it matter?
Sure. So Chainlink is infrastructure that makes smart contracts go to the next level of their capabilities. It connects them to data. It connects them to other chains. It connects them to AI models. It allows them to have various other computations that blockchains don't do become part of them. So, for example, DeFi didn't really exist before what Chainlink invented, which is Oracle networks. Oracle networks are the actual technology that powers the Chainlink infrastructure, and Chainlink invented and originated Oracle networks. And so these Oracle networks basically do all the computations, data connection across chains that smart contracts need to do more advanced things. The simple way to think about it is that the blockchain industry without Oracle networks is like the internet 1.0 or even pre 1.0, where all you can do is send email. But the blockchain economy with Oracle networks is like Web 2.0, e-commerce, video calls, all of these more advanced features that appeared on the internet after new infrastructures came into existence. So Chainlink is kind of the additional new infrastructure that various blockchains need. It works across all blockchains, both public chains and private chains, enabling smart contracts to go far beyond what they're able to do now. And so far, the system has enabled over $12 trillion in transaction value, making it one of the most value-enabling systems in the whole blockchain industry.
Sergey, I know you guys are working on a lot. We chatted a little bit before we went live. We were talking a little bit about what's happening in capital markets, traditional finance, adoption of the blockchain more broadly. Talk a little bit about that and its role in Chainlink that plays in that.
So Chainlink is an infrastructure and a set of standards that allows smart contracts to do more useful things. And now smart contracts are starting to make their way into the banking sector, TradFi, capital markets world, which isn't particularly unexpected from my point of view, but it's something that people have heard so many times in the blockchain industry that it's become kind of almost like a running joke about when's that finally going to happen. But it is now finally happening, actually. So you see big organizations and financial market infrastructures and systems like SWIFT, the DTCC, large global banks, now starting to run their own chains and starting to adopt smart contracts as the method through which they contract with each other as banks, and also in how they move their users' value into public chains. One good example of this are the ETFs, which are just a very, very early version of how the traditional markets interact with the non-traditional public blockchain world. But there's also another world of the chains of the banks themselves. And this world has been in the works for a little bit less than a decade, I would say 7 or 8 years. Those 7 or 8 years is how long we've been working with the largest participants in the capital markets in the TradFi space. Good examples are SWIFT and other folks of a similar size, where basically the value and the operations and the transactions and the events that make up the global financial system, whether those events are the creation of assets, trading of assets, movement of value, whether that's about commodities or equities or funds, all of that is now starting to migrate onto a blockchain. And this is a kind of very big shift in how the global financial system works. And the global financial system is the hundreds of trillions of dollars powering the global economy. So you can basically think of it as the global economy is now transitioning into the blockchain format. This transition only happened once before, when the world transitioned from paper-based systems to digital database systems. This happened in the 70s, 80s, 90s. This led to the emergence of the financial system on the internet. Now, all of that value, all of those operations that you find on the internet are migrating to the blockchain format across various chain technologies. And Chainlink is powering all of those different use cases, irrespective of chain technology, irrespective of use case, because they all need data, connectivity to other chains, additional computations, connectivity with AI models, the ability to interact with AI models in a useful way versus an on-chain event. And so this is kind of the universe that's growing now, in addition to the public blockchain world. I feel that both of these kind of markets and universes of blockchain activity will now be growing in parallel, and the legal barrier between them will gradually be coming down. And as it comes down, they will also need a way to transact with each other. So bank chains with client accounts represented as addresses on those bank chains will want to interact with DeFi protocol addresses on public chains. And then there's a logical question of how does that technically happen? How do the prices get agreed on? How does the value in a form of a stable coin as a form of payment in exchange for something from a DeFi system, or even as a deposit into a DeFi system, how does all of that work technically? That's now the problem that Chainlink is in the process of working very closely on with even now central banks, countrywide exchanges, central clearing and settlement systems. We're in various stages of collaboration with all these big, both market infrastructures and large market participants like banks and asset managers, basically getting them on a single set of standards, just like the Web3 world is on a set of Chainlink standards. Where if you look at DeFi, the majority of DeFi is powered by Chainlink standards in the form of prices and various updates. And so if you get the capital markets on the same standard, eventually those two worlds can interact with each other pretty seamlessly, which is really to everyone's benefit. So initially, the value has flowed into public chains because that's the only place value could flow on chain. Now value is flowing onto public and private chains, and eventually value will continue to flow on both of them, but they will interoperate with each other. Just like you have a single global internet where the bank and the fintech and the random person are all interacting, but they're interacting on a single system, on the internet. And so now you're starting to see a global internet of contracts that includes the public chains and the private chains. And that's kind of the world we're working towards.
So let's set the table here a little bit. You talk about the legacy infrastructure that's in place right now. Mentioned names like SWIFT and DTCC. This is Society for Worldwide Interbank Financial Telecommunications. This is a messaging standards network that's owned by the participant banks, DTCC. This is an absolutely enormous clearing corporation that clears something like I think it's somewhere between 1.5 and 2 quadrillion. That's 10 to the 15 dollars per year in transactions. These are absolutely enormous systems that we're talking about here. I know it's extremely early, but you guys have launched, I believe, a pilot project with SWIFT or DTCC. Tell me a little bit about that. Where is that right now? What's the status?
Yeah, so we're on our second public project with SWIFT, and we're on our first public project with DTCC. The SWIFT project was really about interoperability and connecting multiple different chains, both in the public chain world and in the private chain world, and across those two worlds, and making that compatible with existing systems like SWIFT messages, which are a good container in which you can send instructions. And it is a very widely adopted system for signing things securely. So SWIFT is a very good network in the sense that it has processed quadrillions of dollars in value. It's been live on production, hasn't lost value in over 50 years. So it's successfully operated well. for the most part and stays up and works very well and has been adopted globally. And basically, the question is, why would someone use a different signing method or a different way to instruct transactions? So with SWIFT, we showed that not only can Chainlink and CCIP allow transactions to happen across private and public chains and allow them to interoperate in useful ways, but also that those transactions can be done using existing bank systems, which is a very big leap forward in how banks look at adopting blockchains. So banks kind of have two choices when it comes to adopting blockchains. One is throwing out all of their current systems. The other way is making their systems compatible with blockchains. Banks historically do not throw out systems. This is why you hear jokes like the banks still run Cobalt servers, Cobalt on old mainframe servers, right? This is true. They do run Cobalt on old mainframe servers because there's billions of dollars at stake, and the billions of dollars work in that format, in that server on Cobalt. That works, right? So banks don't usually throw out systems. So the right approach is really compatibility. So the SWIFT work is both a cross-chain interoperability kind of proof point around CCIP, the cross-chain interoperability protocol that the Chainlink community kind of stewards and moves forward, and the ability for CCIP to be compatible with existing systems. And that compatibility will greatly accelerate the speed at which SWIFT's 11,000 banks can get on chain. The work with DTCC is initially about data. It's about putting various pieces of data on chain in relation to fund tokenization. Fund tokenization is very important because the fund industry is where the majority of the financial system's assets end up residing, other than derivatives, right? So you have asset managers like BlackRock, Vanguard, Fidelity, and many others that basically hold both retail consumer wealth and institutional wealth as asset managers. That's the fund industry. And that whole industry is now in the process of becoming tokenized. And the work with DTCC shows how valuable critical pieces of data can be placed on chain in order to operationally accelerate this tokenization, to basically show the efficiencies and the benefits of on-chain funds and on-chain pieces of data around funds. There were also parts of the DTCC work that were around cross-chain and how value can kind of be linked up across chains with the same piece of data, which is another big question beyond just the data and the value. How does the data and value stay synchronized across many different chains, which is another kind of slightly lower level problem. But what both of these public projects and pieces of work show is that the world's largest infrastructures are in the process of adopting blockchain technology and see their participants and members adopting blockchain technology, and they want to offer them useful solutions. And that's very, very significant because SWIFT powers the global banking industry, and the DTCC, because of the position of the US securities market, is the largest single kind of entity and player in the global securities markets, the global equities, securities kind of space. And so these are the people that define how the financial system works. And you see them adopting various blockchain technologies and looking how to implement them in order to allow their thousands of member banks, thousands of participating brokerages, banks, and other counterparties to interact efficiently. And that's also the problem we're focused on. So we're focused on creating an infrastructure that is powered by a global standard, a protocol, just like the internet is powered by a global standard and a set of protocols like TCP/IP, HTTPS, SSL, and others. And so that's the kind of body of work that we tend to collaborate on with these great folks and other top asset managers and banks. It's how to set a global set of standards for value and data to interact with smart contracts and to make more useful smart contracts. And in addition to that, now also computations and connectivity to AI models. But there's a multitude of things that need to happen. And those two things are big steps forward, SWIFT and DTCC.
Hey everyone, listen, if you want to unfuck your future, let me help you. Follow this channel, subscribe, click the notifications, and you'll get everything as soon as it comes out. See you there.
So these are both SWIFT and DTCC about infrastructure, about the plumbing, about the pipes of the financial system. In the case of SWIFT, it's about interbank transfers, it's about signing, it's about messaging. In the case of DTCC, it's about real-world asset tokenization. These are obviously as you point out, banks don't like to throw out systems. This is probably the genesis of the old joke about the guy who gets paid to play solitaire and sip coffee, who is the only person who knows how to oversee that particular component of the COBOL code. This is something that I can attest actually does happen at large banks, or at least it did when I was there, and I imagine they probably still haven't thrown away those systems. How long of a transition do you think this is, in your view, when you look forward to what this transition to blockchain might look like?
Sure. So this is a transition that I've been kind of already working through for the past 7-8 years. Our first public project with SWIFT, I think, went live in 2016, and then we worked with them for some time, even before that. The work with DTCC went public more recently, and really this year, I think you're going to be seeing more and more public projects, POCs, even some production pilots to show the value of these systems working on real transactions. So I think that's kind of the stage that you're at. In the case of DTCC, for example, we were able to put NAV data on chain. So critical data about
value.
Yeah, net asset value of the funds. And this is a critical piece of data that takes a lot of effort and a lot of inefficiency to transact around and move around, and is updated not on a regular basis. So the thing that you're seeing now is that the pilots and the POCs are becoming more focused for real practical applications, real outcomes in the course of this year. Next year, I think what you'll see is something on production with real value, larger and larger volume of transactions for the systems that are already on production. JP Morgan has a system on production. Broadridge has a system on production. There are a few other people doing things in production, and I expect those volumes to continue to grow in the following years. So you see a kind of steady march of more systems getting to the pre-production, post-pilot, production stage. Then you start seeing more and more systems that are on production growing in volume over the next couple of years. And then I think people will look at the efficiencies, and eventually you'll reach a kind of tipping point where people decide, do I issue new things? Do I put new financial products into the old system or into the new system? Well, the new system will now have all the necessary features, all the relevant connections to other banks and other chains over something like CCIP. It will have all the connections to the necessary data to do the operations through something like Chainlink data feeds. It'll have the ability to do it very efficiently, right? So for example, for NAV, instead of, there were like over 10 of the largest asset managers participating in that pilot with DTCC. Usually what they would do is they would send that information to each other. So this is like tens of thousands of emails. Now in the NAV pilot, what happened was we wrote the NAV data on chain, and all of them just read from that one place. And they don't need to send this information to each other or wait for it to be received or prove that they received it or any of this stuff, right? Just as a simple example. So eventually you'll reach a tipping point where new products will either be issued on the old system or the new system, and the new system will reach a kind of feature parity or even go beyond the feature parity level and be better. And at that point, the new systems, the new products, everything will be on there. And that's when I think the migration will really begin in earnest, because everything new, whether it's a more traditional product like a money market fund, or whether it's a newer cutting edge product like tokenized real estate or tokenized private equity, that's when I feel you're at a tipping point where everyone just says, okay, eventually everything's going to be on this. The timeline of that isn't completely clear to me, but I do think over the next 3 years, you're going to see significant growth in volume. You're going to be seeing all of these systems get to feature parity, or in the cases of certain asset classes, go beyond feature parity to be a better system. And then people will be using them to do things for the next set of products, even if they're more foundational products like money markets or something like that. That's the tipping point I would look for, is that the old systems are no longer having issuances made on them, and the new systems are now having the issuances. And then I think you will arrive at a question of larger scale migration of the value from the traditional systems onto the blockchain format. But yeah, I think this is a multi-year project. But if you think about the magnitude of it, it's, in my opinion, completely worth it, because the value of the blockchain industry has to grow from somewhere. And my fundamental question has always been, where is that from? And the answer has usually been some kind of retail hedge fund prop trader group in various countries, right? And then historically, certain new countries opened up that didn't know about Bitcoin or didn't participate in DeFi or didn't have stable coins. But I think we're nearing the mid-late stages of that trend of the average person or the average hedge fund or the average prop trader in every country basically being in the crypto industry. And I think if we're at 2.5 trillion now, maybe we'll grow to like 10 trillion on the public chain side through those groups that I mentioned. The hundreds of trillions that remain will have to come from the capital markets, TradFi, global financial system players. And so I think it's really an inevitability that our industry will come to be defined by that value. The question is how quickly and securely and efficiently and how compliant can we make the migration of all that value into both private and public chains, eventually forming this single internet of contracts where all of this value is interacting. That's kind of the real project I feel our industry is involved in now.
And in your view, the beginning of those real world assets, RWAs, trading on chain, using blockchain technology as a backend, you believe could happen as soon as 2025 for real world applications?
I think in a certain sense, it's already happened. So the numbers that we're looking at, if we estimate DeFi to be in the 100 to 120 billion total value locked category, we're estimating the real world asset market to be in the 140 to 170 billion total value kind of area, general area right now. So what does that mean? That means that real world assets, by the value in them, by some measures, has already flipped DeFi. So there's more value in the real world asset token trend and format and kind of dynamic than there is in DeFi. Now, those two things interact because the real world assets can be put into DeFi as collateral or staked or any number of other kind of useful operations. And by the way, that's real world assets that we can detect because they're public chain real world assets. That doesn't count the real world assets in private bank chains that haven't been made public or aren't very widely marketed or known. So I think we're already in a world where if you're excited about DeFi, and DeFi went from a sub 100 million industry when Chainlink started to an over 200 billion industry with Chainlink powering the majority of DeFi throughout the course of that growth. Now we're looking at real world assets and we're seeing that in the very early stages of real world assets, when most people don't even know how much value is in there and they're wondering if that will be a big deal. Even now, against the current value in DeFi, RWAs are more. So we're now in the very early stages of RWA. It's already more than DeFi. And if you think about the amount of value that can be tokenized against real world things, which is also where Chainlink comes in, because that real world connection back to the asset is another thing that Chainlink provides. And there's now been some independent analysis that shows that Chainlink is a very widely used framework and format and set of standards for those real world assets to prove things about themselves, such as that the real estate doesn't have any new debt, the gold bars are actually there, or whatever other thing. The whole point is that it's a real world asset. It's not a cryptocurrency in the sense that we didn't just make up, something and decided that it's worth something because there's a buying and selling kind of bid-ask spread meeting of price. It's because it's tied to a real thing in the real world, which is, by the way, one of the big things that the whole banking sector does, right? Is it basically packages real world things into financial products, and it provides those financial products to the whole spectrum of retail to institutions. So,
by the way, and we should say, for better and for worse, much of the 2008, 2009 financial crisis was around the securitization of assets, specifically around home mortgages, where there wasn't the transparency in that. And I think that one of the things that people who are passionate about blockchain technology see is the opportunity to potentially have greater transparency of understanding what is in these asset packages. And that's something that the blockchain technology can potentially facilitate.
Yeah, it's not even potentially, because we've proven many times now with many different market participants of monumental, very significant size, that it's not a maybe, it's a for sure. Like the way that the global financial crisis would have been avoided if blockchains had been a prevalent, widely used technology. I can tell you right now, because it's a problem I've worked through and thought about a lot, is every single mortgage holder, individual mortgage holder, would have their own smart contract. And the smart contract would represent a single person, you or me, and then it would have various pieces of data appended to it about how many houses we own, maybe our credit score, and it would be dynamically updated if something changed. So if you and me went from owning one house or two houses to 15 houses, and then our credit score dropped, and then somehow, we're on unemployment or we don't have income or whatever, all of that information could somehow be packaged into an on-chain record.
Right.
And then all of those on-chain records together, those millions of individual smart contracts, could be rolled up into the RMBS, CMBS, the mortgage-backed security format. But now you don't have to be a John Paulson or any number of a very limited number of people that were able to go down to this level of depth and understanding that within banks only a few people had, like CDO managers. Now you kind of arrive at a world where everybody can analyze that, just like everybody can analyze a DeFi protocol and see what its solvency is. And everyone can look at a blockchain transaction on a block explorer. So I think it's an immediately solvable problem. And another good example is the default of banks. So the thing that I always ask people to think about is, imagine if you knew every single piece of information about the health and progress and solvency of your bank or asset management partner that the CEO of that bank knows. Imagine if you had direct access to everything going on there. You didn't need to wait for accounting audits. You wouldn't need to wait for rating agencies to make decisions for you. You would just have the information. You would be able to see, oh, wow, this week, the bank underwrote a lot of really high-risk debt. That's not good. Let me monitor that. And maybe if that keeps happening for a second week, I'll see what I want to do with my money in there. Instead of waiting 10 years and then finding out, oh, the bank underwrote huge amounts of high-risk debt. Nobody seems to have known about that very clearly. Guess what? We can't access the money in the bank. Time for the US government to print more money to save the bank and create like an artificial tax on everyone, right? Through inflation. So it's a very, very significant change just by the market being able to access information. And the market is able to access information because the smart contract is this kind of agent, this impartial agent, this box that can't be manipulated, that you can put all the information in, but no one can manipulate it. And so everyone can trust it. And this is the thing that hasn't existed. And this is the thing that people have continued to even now still confuse between what blockchain technology they think it is and what it actually is. What they think it is it's some kind of weird oddity. What it really is the way that all transactions, all data about value, all issuance, all management of value, whether that's insurance-related value, whether that's equity-related value, whether that's commodity-related value, real estate-related value, will be transacted because it's just a superior way to do that. And this is the very big shift that I see more and more people understanding, but still is not fully understood because, frankly, as I dove into the kind of capital markets, TradFi, global financial system rabbit hole, and I started understanding step by step, every single step that happens in a transaction. For example, for a delivery versus payment transaction, all the settlement steps, all the payment steps, all the reconciliations, all the things that need to happen for a transaction to successfully conclude. I mean, you find an unbelievable amount of stuff that is just completely and totally solved when you can put a piece of data on a blockchain and prove that something happened. And so the blockchain is the mechanism where that data goes, and the Oracle network is the thing that does the proving that it happened.
Sergey, aren't you still, though, at the mercy of the data that comes into the system? Is that a question that you guys have wrestled with? How do you get the data into the system, even if you have this cryptographically secure way based on mathematics and physics to secure the information once it gets into the system? How do you get that last mile of whether or not I've bought 12 houses in the last 6 months or not, whether I have employment verification or not? How do you control that component of the system? And have you thought about that?
Sure. So you make it more transparent as to where the data comes from and how it's aggregated into a final answer is the basic answer to your question. So we have a proof of reserves system within the Chainlink set of protocols and standards. And the proof of reserve systems shows where the data comes from. Now, the data can come from multiple APIs, and then it can be aggregated to get you to a final answer, or it could come from one API. But that one API, you know who it is. And usually the way people construct this is it's someone that doesn't have a vested interest in whether that financial product works out. Their job is just to provide the data about whether the gold is there, whether the financial product is actually backed by something. So the deeper answer to your question is that Chainlink is a framework for constructing consensus around all of these things that happen outside of a blockchain. So you and me could get together and say, we need 3 data sources in order for us to consider a piece of data as authoritative for the purposes of our transaction. And here are the 3 data sources we want to use. And then we compose those data sources into an Oracle network with some nodes, and we know who the nodes are because the nodes were also selected. And then we can show that to a third person that wants to come and participate in buying that asset, trading it, dealing with it, because now they know both the smart contract code and they know what's triggering the asset. And you actually need to know both. And so as the value in the asset grows, as the value in DeFi protocols grow, what we often see is the amount of oracles in an Oracle network increasing and the amount of data providers increasing because the value they control has grown to become greater as well. And so this is also a dimension of what the Chainlink protocol and set of standards seeks to solve, is to give developers and people who compose these systems an easy and simple way to define what reliable data is and to connect all of the necessary different data sources and to aggregate the data in a transparent way that proves to everybody that the data is also resistant to a certain level of manipulation.
And how long do you think that process takes? You have to create the standards, you have to get the end software built to suck in the data at the last mile. How long of a process do you think that's going to be before we're able to get reliable data on a blockchain that's aggregated and has sufficient decentralization to enable the type of ability to authenticate the data that you're talking about?
Well, that's what Chainlink has already done for DeFi. And so far on public chains, there's over $12 trillion in transaction value that's been enabled through that process and some cross-chain and some other things. So I would say in certain categories of applications, like certain DeFi categories, that already exists. And that's one of the...
I guess the distinction is that for DeFi, it's already native on chain, right? So the data begins on chain with DeFi, and then you're able to aggregate it centrally in a decentralized way, in a way that you wouldn't be able to do with something like employment data. How do you get that data onto the chain?
Nope. For data doesn't begin on chain. The data begins off chain. And then the Chainlink system aggregates the data and proves with a sufficient amount of data sources and nodes that it meets certain reliability and the manipulation resistant standards. The data that people rely on that's generated on chain, like DEX data, is actually the thing that's most commonly manipulated when people want to manipulate a DeFi protocol's prices or something like that in the course of something like a flash loan attack. Right. So this is already something that is solved on certain dimensions of data by the Chainlink ecosystem. And now the challenge is to extend both the amount of data sets that can be aggregated in this reliable way and to apply other capabilities to smart contracts, like the ability to interact with AI models, the ability to go across chains, the ability to interact with various computations that don't exist on a chain, but a smart contract needs to do something more valuable, like interact with a Monte Carlo simulation as a determining factor for a trade or something. So there's all these off-chain activities that need to be made reliable in order for them to be combined into a smart contract. One of those is the data aggregation activity, which this is what Chainlink initially solved through the invention of decentralized Oracle networks, DONs. And now that's being expanded to more and more categories of computation, basically off-chain computation. So not on-chain computation. On-chain computation is consensus around a ledger, the existence of a token, the movement of a token, those kind of basic activities and certain state machine, state changes defining how the token works. Like, if I receive this price from an Oracle network, I can give you this much yield or something like that. But the next stage of pretty much all advanced smart contract applications, including real world assets, require decentralized Oracle networks to provide them pieces of data, provide them connections to other chains in order to transact against the counterparties they want to buy the asset, and give them various computations like access to AI models and all kinds of other off-chain computing systems and services. This is what Chainlink does across chains and across use cases. Is it fundamentally solves this problem of how do I interact with off-chain systems in a way that approaches the reliability of on-chain systems. And that's why it's a very unique and useful system.
You began your answer by saying that DeFi data does not natively begin on chain. Explain what you mean by that.
I mean, the price data driving a lot of DeFi is generated off chain to achieve like a global price of a cryptocurrency. To achieve the global price of a cryptocurrency, for example, you have hundreds of different exchanges. Those hundreds of exchanges are the ones that right now determine the price. The price of cryptocurrencies right now, with cryptocurrencies as just one example, is not determined on chain. It is determined by the trading activity of various off-chain exchanges. And so the price inherently comes into existence off-chain. Then it is aggregated by data providers and data aggregators. And then it is eventually fed into Chainlink Oracle networks that aggregate the data from those data providers into a final answer that powers DeFi. The only price data that's generated on chain is really DEX and perp data. And DEX and perp data is relatively straightforward to manipulate, which is why you hear constantly about flash loan attacks. So that's just for crypto data. If you take any other asset that isn't a crypto asset, a cryptocurrency, like a commodity or equity or something else, then that data right now, by definition almost, is generated off-chain. Right. Because trading activity and that price discovery activity doesn't happen on blockchains. It happens in various off-chain centralized systems, exchanges, and so on. So the whole big thing that Chainlink initially solved was getting off-chain data reliably on-chain so that DeFi protocols could be constructed around it, both derivatives protocols, lending protocols, all kinds of protocols that couldn't exist without highly reliable data coming from the off-chain world where it's generated initially for use in the on-chain DeFi contract. This is why Chainlink powers the majority of DeFi and why DeFi was a sub $100 million total value industry when Chainlink started with, I would say, a handful of teams. I mean, we're talking like tens of teams, 10, 20, 30 something teams that were like real teams trying to do something. And why, with Chainlink powering the majority of DeFi, it grew to an over $200 billion industry with thousands of teams. It's because this problem was an unlock, just like smart contracts, composable, editable smart contracts were an unlock created by Ethereum. So that's why Chainlink is so widely used, because just like Ethereum invented these highly editable Solidity smart contracts, Chainlink invented and originated kind of configurable Oracle networks. There are over 1,000 Chainlink Oracle networks on production at this point. It's fluctuated about 1,000, a little less, a little more, depending on which ones get spun up. If you count testnet and staging, there's thousands of these Oracle networks for all the different variations.
These are the dawns that you talked about. The idea that these networks are
essentially. Yeah, so decentralized Oracle networks are the kind of unique idea and invention that has now worked within the Chainlink ecosystem. So the first decentralized Oracle networks were generated by Chainlink. They gave rise to the first successful working DeFi protocols, because a DeFi protocol is basically a set of on-chain contractual conditions, and it's an Oracle network that proves those conditions happened. If you don't have both of those things, you can't make it work. You need both. And so there were a bunch of people trying to make DeFi work because it's a logical idea. But then they were always stuck on, initially they were stuck on how to make a smart contract work. And then Ethereum solved that problem. And then they were stuck on the problem of how to get the proof that something happened to the contract for it to resolve. And that's what Chainlink and decentralized Oracle networks solved. So that's what we initially solved. But now all of that has evolved far beyond just data. It's evolved into cross-chain connectivity to computations like AI, all these other things. Basically, anything that a smart contract needs to do a valuable operation, an Oracle network should be able to make more reliable so that the smart contract can rely on that input. And the Oracle networks can also act as agents on behalf of the smart contract to affect things like traditional payments or other off-chain events. So the analogy that sometimes I hear used is that like smart contracts, like with smart contracts without Oracle networks, are like cities without electricity. Like everything is there, but it won't necessarily work unless you give it electricity. And the Oracle networks give it all of this connectivity and all of this additional computation to allow the smart contracts to go beyond on-chain operations, which are relatively limited. For example, we in the Chainlink universe of standards and protocols have an automation solution because smart contracts do not know what time it is. They don't know whether it's 9 a.m. and the market is opened or it's 5 p.m. and the market is closed. The only thing a smart contract actually knows is what block they are on. They don't have a sense of time. And so you need something like automation basically to trigger the smart contract to do its operations. And even that, you need an Oracle network. And if that Oracle network is not reliable, then the smart contract doesn't get triggered, which leads to all kinds of attack vectors where you can start to manipulate.
And the reason you need an Oracle network for something like time is because if you want to truly decentralize this and you want to have multiple sources that are difficult to intercept or spoof or have an attack vector against, the more widely distributed those sources are, the more decentralized, the more robust and stable and tamper resistant the system becomes.
Right. That's right. So decentralized Oracle networks have a configurable way to be decentralized. So you could make a decentralized Oracle network out of 7 Chainlink nodes, 16 Chainlink nodes, 21 Chainlink nodes. There's a big gamut of different numbers of nodes. And you can also configure the amount of data sources going into those networks. This is one of the big challenges of making decentralized infrastructure is that you have to make a system that can be composed of various independent parties coming to the same conclusion and then aggregating their results in a way that none of them can tamper with it. And so this is what decentralized. Yeah.
As you get greater decentralization, how does that affect things like speed, latency, throughput, et cetera?
It depends really on who the node operators are, what resources they have, what investments they've made in infrastructure themselves, the quality and speed of their connections, and all of that can also be configured. So generally speaking, the more that people need to come to consensus, usually the more of a performance that you take. But up to certain levels of decentralization that provide what I feel and what other people feel are a sufficiently high level of security and tamper-proofness, you can achieve very fast speeds, very high levels of reliability, and so on. it really boils down to what the node operators are willing to run and how much they're willing to spend in terms of their time and effort and uptime and all this type of stuff. But it's a solvable problem.
At the speeds necessary to handle trading, for example.
Sure, depends, right? There's all kinds of different levels of trading. If you're talking about like high frequency forex trading, that high frequency forex trading in the blockchain world would happen on a blockchain. So your first problem wouldn't be the speed of the Oracle network. Your first problem would be generating a trading environment that can even execute those trades at that level of speed that's needed by all of those participants if they're in different places. Right now, in all of our experience, the Oracle networks are not the bottleneck. It is pretty much always the blockchain technology that's the bottleneck in terms of the speed at which it can operate and provide its computations. So right now, we're not in a world where the Oracle networks are the bottleneck. We're in a world where the blockchain's technology, confirmation times, you need to wait 6 blocks until you have finality. You need to wait this long until you can consider the transaction truly reliable. All of those kind of probabilistic transaction reorg related risks right now don't really make the Oracle networks the stopping point. It's always the blockchain pretty much.
Really interesting. Talk a little about how Chainlink works from the perspective of tokenomics, what the role of the token is in the ecosystem.
Sure. Yeah, so the Link token is there for utility for people to purchase the services, the secure Oracle networks and how they're utilized. And it basically enables people to gain access to all the capabilities in the system, pay for them just like you would pay in Ether for Ethereum computations and so on. And that's kind of the dynamic. So it's a pretty direct dynamic.
So essentially, it's purchasing utility processing power throughput in the network to actually perform the transaction of validation of oracles.
Yeah. Just like in Ethereum, you get some Ether, you pay for the transaction, you say, hey, I want to do this computation. In Chainlink Oracle networks, you get Link, you pay for the necessary computations, whether it's a data-related computation or some other automation computation or a cross-chain event or whatever set of events. That's what it's primarily used for right now. Yes.
Sergey, we talked a lot about the actual nature of the infrastructure, how it functions. Talk a little bit about what folks who are not following this nearly as closely as you are should be looking for. What do you expect is going to happen next? What will be some signals that this adoption is becoming more widespread?
I think people should pay attention to the real-world asset trend. I think they should look for how the real-world asset trend interacts with the DeFi industry, because I think there's a lot of really big potential there. I think that's a market that will have a lot of value from what the real-world asset folks are doing, and that those two worlds can kind of interact in very valuable ways that benefit both of them and allow both of them to grow. So I think that in and of itself is a trend encapsulated within the public blockchain world itself, right? So that can happen without any bank adoption or financial market infrastructure decisions or anything. Then you have the parallel world of bank chains, private chains, asset managers, financial market infrastructures, the global financial system, traditional systems that have hundreds of trillions of dollars in value on them. And in that world, I would look at what's going to production, how many systems are in production, how many of them are actually doing transactions, how many of them are doing greater numbers of transactions, more volume in those systems. And interestingly, how many of those systems might be interoperating with each other over a system like CCIP that would allow them to do valuable operations and transactions across multiple private bank chains and blockchains owned by institutions. And then you kind of arrive at a world where you'd continue to have these two parallel worlds of a public blockchain world where there's a lot of permissionless innovation and there's a lot of great kind of unique things happening, both in the DeFi world, the real world asset world, maybe the GameFi world. That can, I think, be a very interesting place if people really get that right and have a sustainable economics and ecosystem. So you have the public chain world kind of growing in the DeFi, RWA, and GameFi categories. Then you have the traditional world growing. And then the collision of those two worlds is also going to be a very big deal. because both of those worlds are fundamentally involved in the same thing. They're fundamentally involved in doing transactions. They're fundamentally involved in doing delivery versus payment, sending a form of payment for an asset of some kind. They're both generating assets. They're both representing user accounts with purchasing power that want access to more assets and want to put those assets in yield-bearing financial products and instruments. So those two worlds, in my opinion, will eventually collide. And that collision of those two worlds will allow them both to grow. It'll make the public chain, RWA, DeFi world grow significantly because of all the value in the institutional world. And once that institutional world value can both efficiently, securely, and in a legally compliant way flow into public chains, that's kind of like what the ETFs are. The ETFs are the first very early version, or like not the first, maybe the second, because you had some stuff before the ETFs that did slightly similar things, but with more friction and more problems. But basically, the traditional system will feed the public blockchain system value, and the public blockchain system will feed extremely innovative but high-risk assets and applications to the traditional financial system. But the traditional financial system has a significant percentage of its population that wants the most cutting-edge, sometimes high-risk assets and yield-bearing products and instruments. So these two worlds are really kind of made for each other. They just don't seem that way because they can't or don't transact with each other yet. But they'll both be growing in their own way, and then eventually they'll merge into one, what we call Internet of Contracts. And it is this Internet of Contracts that we're basically in the process of building the global standards for, whether those are standards around data, whether they're standards around cross-chain connectivity, whether there's standards around how to do off-chain computation, whether there's standards about how to define AI interactions with smart contracts. All of those things require shared standards so that when a Web3 DeFi protocol wants to interact with a private chain bank user, they know how to do that, right? They can agree on a price. They can send the stablecoin and receive the asset. They can verify that this is allowed or is a good idea against an AI response. They can verify that it's legally compliant against the CSD signature or something like that. So basically, these two worlds colliding, I think, will be the biggest signal.
Sergey, it's always a pleasure to have you on the show. I always enjoy these conversations. Final thoughts, key takeaways that you'd like to leave our viewers and our listeners with.
I think the next 5 years are going to be very interesting for all of us, not just in the blockchain world, but just in the world generally. I think our industry has a very big role to play because if the world becomes more unstable, the system that provides reliable stability is going to be very important. And I think the blockchain industry has matured to the place where it can secure very large amounts of value. And it's going to now mature to the place where it can do that in an efficient and legally compliant way. And if the traditional world has problems, whatever form they might take, then I think the non-traditional crypto guarantees will be more attractive than more traditional systems guarantees. And that is another thing that I think can kick off a big migration. But all in all, it's going to be very interesting. And I think our industry is going to create the reliability that the world needs to continue to operate. And I think that's a very useful and important thing.
You know, Sergey, I think one of our first conversations here on Real Vision, you talked about this notion of verifying things with physics and mathematics rather than trust, rather than brand identity. And it is a major paradigm shift in the way that the world works. And it's going to just be an incredible time to watch. Thank you so much for joining us.
It's my pleasure. Thank you.
Thanks for watching, everyone.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token2049.
We hope you enjoyed the video. At realvision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.